You came off the
Correct, yes.
CIO panel, so everything's still there.
Correct.
Key takeaways, what did you guys talk about?
I think we talked certainly about the headwinds that everybody's facing. The two topics that we concluded clearly is geopolitics, big election year, so
yep.
that's certainly the headwinds. We talked about valuations. You mentioned just now that the markets are at all-time highs. So the debate is it priced to perfection at the moment in terms of is there a recession or not? Our thesis is there will be still a mild recession potentially in the second year, although I think a very mild one. I think key here will be diversification, and so the panel also concluded that going into fixed income as a good risk-return trade, potentially extending your duration gradually a little bit. When it comes to Asia, we like local currency bonds because that potentially cushions a bit against a potential weaker US dollar.
Okay, lots of doors you opened up there. So on fixed income, you mentioned upping in duration. So inflation remains, is that now a tail risk? You know, that last leg to get back into target, because we've gone most of the way already as far as inflation coming down. So you're comfortable going up in duration at this point?
I think it's fair to say that that last mile of getting inflation down has been extremely hard. And certainly that tail risk remains, but we do believe that actually at the yields that you get, particularly in investment grade, and you extend a little bit your duration, you will get fairly compensated for that in a time when probably there is a lot of uncertainty, particularly on equity valuations.
And probably also has the dollar peaked, the dollar weakens from here because you have a call in local currency.
Correct. So our take is that the US dollar will be somewhat weaker, and that should give you then the benefit of diversification, particularly in Asian local currencies.
Right. What about equity markets? Europe's done very well. You were mentioning that, right? The US has done, we know what the US has done. Right? How do you feel about Asia?
Well, I think it's, again, I would repeat, we think we're neutral on equity overall, but we do believe that developed markets are really priced to perfection. So we prefer emerging markets. And I give you a few numbers around Asia. If you look right now at valuations, Asia's growth, economic growth for this year is nearly double forecasted than the US. You look at valuations, Asia is nearly half of that of the US. If you look at earnings growth, again, nearly double forecasted here in Asia. And the last fact I would give you is that when you look historically, when the Fed has cut rates historically, Asian equities actually have outperformed the US market by nearly double. So I think diversification, if you need to hold equity or want to hold equities, we prefer to do it by buying quality stocks with good dividends that have solid balance sheet, good earning powers, and I think that will ride you through also potential mild recessions going forward.
Okay, do you get a sense that there's certainly a very strong argument to be made on Asian equities? Is there pushback still though from clients on, look at NVIDIA, that's done very well. Why can't I leave my money there? Magnificent Seven, for example. So what's the counter argument apart from what you've mentioned?
I think the pushback on Asia is less about Asia per se, but China is obviously a very big topic still. So we are educating a lot of our clients globally that Asia is well beyond China. There are great opportunities for companies around India. We talked a lot about Japan. We talked about Korea and Taiwan. So I think diversification, picking up stocks and select stock with good balance sheets, that is really absolute key. Valuations, to your point, they are not cheap either in Japan or India for that matter, but I think the diversification upside is certainly the key element going forward.
Right. In Japan, you guys are busy there. Like, what's that next leg looking like for you? Because who would have imagined Japan would do as well as it did last year?
So we just had a discussion actually on the panel on stage earlier that just a year ago, when you travel to Japan, people clearly saw the directions that governments and the Hong Kong, the Japan Stock Exchange wants to drive for more corporate governance and the like. But there was not a real belief. If you travel now to Japan and you speak to colleagues, there is a sense of, oh, this is actually really changing. And I think, so the conviction is visible. We see it in the stocks we pick. We see the activities that the companies have. There is real momentum. Time will tell whether it really follows through, but I certainly think sentiment-wise, that's a very, very positive development.
Yeah, very strong tailwinds. And what about India?
So India obviously is a market we really like because it's early cycle of an economic upswing. We are very positive, particularly on the fixed income market. So India bonds will be this year going into the emerging market indexes, right? That should be also a catalyst for more interest. We see it as a fantastic diversifier across Asia Pacific and emerging markets overall.
You don't seem excited about China.
I think it's a question of confidence. I think I have been at your program last year, very similar time.
Yes,
and I
know what was happening then.
And I was it was my first trip back to China after COVID, and I was convinced that that sort of like reopening trade will allow a momentum. That did not happen, as we know. I think the economic transformation that the government is engineering will take time. Okay. So it's a confidence game. But I would stress to you, if you own China companies, we own companies in our portfolios with great balance sheets, great business models, great earnings growth, but confidence into the market, that will take time. I think if you have a longer time horizon, I still believe that valuations are very undemanding for China.
Right. What catalyst do you think we need to see still? It's all about the delta, right? You know, do you incrementally add China exposure? Do you chase in Japan? So fine, Japan, you own Chinese companies right now. Would you be increasing at this point, or are you?
So happy? I think for China, when you say what is the catalyst, it's policy consistency. I would argue, like you need to have it over a longer period of time to really follow through. Yep. As you know, there is a significant real estate bubble that has bursted. That working through takes time. I think the China government makes excellent moves to sort of like address step by step, and they're trying not to make the same mistake as in 2007 and 8, where they really did the bazooka stimulus that really created the bubble in the first place, right? So I think it takes time. Confidence needs to restore before you see meaningful flows, long-term flows coming back to China.
Right. Final question, alternatives. We haven't gotten to that. It certainly took up a bigger portion of portfolios last year than the year before. What should this year look like compared to last year?
So we certainly see great opportunities in alternatives as a diversification element. You can pick up, given the interest rates spikes last year, inflation, you get very discounted prices right now. We are looking particularly, in our case, European real estate has not repriced yet. So we are raising a few capital raises around European real estate, thematics. There is definitely room for opportunities in portfolios for diversification.